Well, welcome everyone to our webinar today on the flexible crop insurance option whole farm revenue protection. So I hope you're in the right place. Thank you so much for registering and for logging in today. We're going to be talking about the whole farm revenue protection, and so let's go ahead and get started. So the first thing is I'll start off with some quick introductions. There are two names at the Center for Rural Affairs that you should know. Myself, I'm Anna Johnson, the policy manager with Center for Rural Affairs, and this is my email. And then my colleague Cora Fox is a policy associate, and she's going to be leading tomorrow's webinar. And she was on our webinar on Tuesday, but unfortunately she isn't able to join. So I think you've already heard from my wonderful colleague Cody Smith, a policy writing assistant at the Center for Rural Affairs. He is on the line with us, offering support on technical questions, including to me. Thank you, Cody. And if you have questions about the webinar platform, please don't hesitate to reach out. So to that end, we really encourage your questions throughout the webinar and after, so please don't hesitate to reach out, and please consider us a resource. If we don't know the answer to your question, we'll find out who does. And a quick flag on the GoToWebinar platform. If at any time during the presentation you have a question, there are two things that you can do. First, you can type your question into the question box that you should see on the GoToWebinar little window, and then there's also a way they've taken our old classroom practice of raising your hand and made a digital version of it. So there should be a little hand button on your toolbar as well that you can click, and then that will alert us that you have quote unquote raised your hand, and then we can pause and chat. So please don't hesitate to use either of those functions. And then the last thing is you should also have a little mute button, or a little sound button that is looks like a small microphone, or if you are calling in with a call-in number, it might look like a little telephone. And when it's green, you are unmuted, and when it is red, you are muted. So, and I believe that you can unmute yourself. So again, please feel free to chime in, and then we'll also have time for questions and answers at the end. And then the last piece of housekeeping is to flag that we're recording today's webinar, and all of this week's webinars, and we will post them on our website at the Center for Rural Affairs when they're all completed, hopefully next week. So since you registered for this webinar, we'll email you out the link when those are up, so you can share with your friends too. So next, a few things about who we are. If you're not familiar with the Center for Rural Affairs, we are a nonprofit organization. We are founded in Nebraska, and then I'm based in our Nevada, Iowa office. We stand up for family farmers and ranchers, new business owners, and rural communities. For more than 45 years, we've been the leading force engaging people to build a better future. And our mission is to establish strong rural communities, social and economic justice, environmental stewardship, and genuine opportunity for all, while engaging people in decisions that affect the quality of their lives and the future of their communities. And we have three different kind of program areas at the Center for Rural Affairs. We have a small rural business lending program in Nebraska, and we have a program that does a lot of farmer education work, and then and other kind of community technical assistance work. And then Cora, Cody, and I are all on our policy team. So we certainly keep busy, and education is a key piece of our work as an organization. So. And if you registered for this webinar, you likely saw our announcement that we're having a series of webinars this week. We have one more tomorrow. Please tune in if you're able. It will be on revenue insurance options for livestock. And Cora Fox is going to be leading that. And again, we're recording, so we'll post the recordings of the webinars to the website also if you can't make it tomorrow. So let's dive on in. You all came to hear about whole farm revenue protection. So I'll lay out some of the goals today. So first, hoping by the end of this you are able to answer these questions to some degree. First, what is whole farm revenue protection? The second is, how does whole farm revenue protection work? And would whole farm revenue protection be right for my operation? So I hope that we are successful in that goal today, in those goals. And a quick note. about terminology. We're talking about the crop insurance policy, whole farm revenue protection. I am probably going to be saying the words whole farm, and then also you'll see on the slides the letters WFRP. These are all the same thing. It's not a farm program if you don't have an acronym. So you'll see the acronym a lot, but just know that that's what I'm referring to. So it's helpful for me in sharing with you to make sure that I'm sharing information that's useful to know get to know you a little better. So if you don't mind answering a couple of quick questions, I would really appreciate it. We have GoToWebinar has a cool little feature. Let's turn it on. So the first question is which of these three things describes you best? How long have you been farming or ranching? It's basically where we're going. So if you just take a couple seconds to put your answer in, I'd appreciate it. Beautiful. Thank you so much, everybody. We're moving on. I've got one or two other people who haven't voted yet. Okay, well, let's call it good. So we have about 40% of folks who responded have been farming or ranching for more than 10 years, and 60% who are not currently farming or ranching. So I hope what we have today is going to be useful for everybody. We have another quick poll specific to whole farm, so I can have a sense of how useful whole farm might be for you. Do you currently grow or raise crops or livestock that you want to insure with crop insurance, but you weren't able to? Wonderful. Thank you, everybody. Okay, so we've got most people saying that that no to this question, but some people saying yes. So that's helpful to know. Thank you, everybody. And then the last poll is just a quick question about how familiar are you with crop insurance? Wonderful. Excellent. Thank you, everybody. We've got a lot of people who are answering no to this question. So so it sounds like crop insurance is a new thing for lots of people on the call. So that's helpful to know, and I hope that we we share with you helpful information today. So thank you so much, everybody, for indulging me on the polls. And so without further ado, let's dive in. So to understand how whole farm works, it helps to understand a little bit more about how crop insurance works more broadly. Crop insurance is managed by a public-private partnership between the government, that's United States Department of Agriculture, specifically their Risk Management Agency, or RMA. They set crop insurance policy with private businesses, and these businesses are called approved insurance providers, or AIPs. And then AIPs in turn work with individual crop insurance agents to sell you crop insurance policies. And so when you're buying a crop insurance policy, the parameters of what that policy contains come from that partnership between USDA and the AIPs. Another thing to know is that crop insurance is subsidized by the federal government through two ways. One is in the premium, the part that you pay, and that those premiums are subsidized so that you end up paying a lower amount, and that the amount of subsidy varies by policy, and we'll get into that a little bit more. And then also another way that crop insurance is subsidized is with an agreement with the AIPs also receive the subsidy. Whole farm revenue protection, which we're talking about today, is an RMA-backed product and is federally subsidized. So folks who were on Tuesday's webinar will remember that we highlighted research you can do using RMA's Actuarial information browser to see what policies are available in your county. It's a handy tool for that and many other things. Perhaps you've used this tool. Ooh, good. Okay, yes. I saw the poll thing for a minute again. I thought I'd stuck, but you guys are seeing the slide. Good, okay. So perhaps you used this tool or researched crop insurance for a crop, but found there wasn't a plan available for it. So that brings me to the value of whole farm. So many crop-specific insurance policies aren't available everywhere. And the example I used in our previous webinar was apples in Story County. There's no policy available from RMA for apples in my county. So examples of commodities that might not be covered by individual policies include like many fruits, vegetables, small grains, organic crops, livestock. Whole farm covers the commodities produced during an insurance period, whether or not they are sold, commodities bought for resale, and all farm commodities except timber, forest, and forest products, and animals for sport, show, or pets. So whole farm is there to step in to cover crops and livestock that you can't cover with other plans. So obviously it covers a lot. One final point on this is I wanted to just note that I'm going to be using the word commodity throughout the webinar. Whole farm policies, they use the word commodity to describe both crops and livestock. And I'll probably be doing that same thing for that convenience, but I don't want to confuse anybody in that. So whole farm helps by allowing you to insure commodities that aren't otherwise insured. And which decreases your risk level. It's and it's in the name, whole farm revenue protection. It protects the revenue of your whole farm. So, so some of the basics of whole farm, obviously it's revenue insurance. In other words, it allows you to insure your expected revenue for the year. This is how it is able to provide insurance coverage for those less common commodities, like apples in Story County. That's my go-to example. But other forms of insurance rely on yield data from previous year's harvest and other farms to calculate your risk of loss and sell you an insurance plan. But because whole farm insures your revenue, what you have to prove instead is a good estimate of your expected revenue. And so we'll get into that more in a minute. Another important point about whole farm is that it supports on-farm diversity. The idea here is that diversification actually helps you spread your risk around and decrease it. So you receive a higher premium subsidy. In other words, you pay a lower premium on a whole farm policy if you produce more than one commodity. So it incentivizes that diversification. And you actually receive a higher subsidy if you can show that you have two commodities instead of one. And also if you want to purchase the very highest levels of coverage, that's 80 and 85%, you have to prove that you have three commodities, that you're covering three commodities. So if you want to get into the weeds of how whole farm works, there's a specific way that commodities are counted, essentially to prevent a plan where you're growing 1,000 acres of one thing and half an acre of another and calling that diversified. But the general idea here is to encourage diversity. So happy to talk more about that if needed. So let's get into the details of what whole farm offers. There are limits to insurance coverage available under whole farm, but whole farm is still pretty generous. It'll allow you to insure up to $8.5 million in insured revenue, and that insured revenue is calculated based on the coverage level you choose. You can cover up to $1 million in revenue from animals and animal products. So there's that as a separate lower limit for livestock revenue. You can also cover up to $1 million in greenhouse and nursery revenue. And the example that I heard from an RMA employee was this means like bedding plants that are produced in a nursery, but it doesn't mean tomato plants that you grow in your hoop house. Tomatoes, specific like tomatoes that you grow in your hoop house and sell at farmer's market. I'll say that one more time because it was a little confusing. So this greenhouse revenue, greenhouse and nursery revenue limit applies to things like bedding plants that you're raising in a greenhouse, but not to like single tomatoes that you're growing in a greenhouse and then selling as as food. So whole farm will also cover up to 50% total revenue from commodities purchased for resale. And you can combine whole farm with other crop insurance options. So this is the buy-up option. But indemnities from those other crop insurance options will be counted as revenue under whole farm. So this last point, if you already are growing, if you already grow and insure corn and beans, and you want to insure a crop like organic oats, an additional crop, you can use the buy-up option under whole farm, and the two policies will work in tandem. There we go. So whole farm covers the revenue produced in the insurance period. So a commodity not harvested or sold will actually count as revenue. A commodity grown last year and sold this year will not be covered. For commodities that grow in value each year, like cattle, only the growth in the specified insurance year counts. So an example here is that if you have a calf that's worth $800 at the beginning of the year and it will be sold at $2,000 later in the year, you're going to insure the difference in that value, which is $1,200. And then there are other activities that you may be doing where you add value to a commodity. Actually, never mind, I'll come to that in a minute. The last thing to say about revenue is in order to kind of work with your agent and determine what your expected revenue is, you look at your inventories and accounts receivable to determine these produced amounts for the year. One point I wanted to make that I almost got into is about what revenue is not covered. The cost from post-production operations, not considered market readiness operations, must be removed from the allowable revenue and expenses. So this includes activities such as canning, freezing, and processing. So I wanted to make sure to have this slide in here, and I pulled this directly from RMA's website because I think at one point when I was talking about this webinar, I mentioned the value add, mentioned the role of value add, and so I want to make clear that whole farm doesn't cover many value added activities. So making a special note of that. But it does cover, all things I said before: fruits, vegetables, small grains, organic. So another important thing when you're learning about a crop insurance policy is what losses are covered. So whole farm covers loss of revenue due to unavoidable natural causes that occur during the insurance period. So this includes a decline in local market price unless RMA specifically decides otherwise. So we'll talk a little bit about filing in a minute, filing loss claims. Now, coverage levels, I mentioned this a little bit earlier. Like many other crop insurance policies, coverage levels of from 50 to 85% are available under whole farm. So for those who aren't familiar with crop insurance, that's, you want to cover 50% of you want to buy this is if you want to buy an insurance plan to insure 50% of your expected revenue, or maybe you want to insure 85% of your expected revenue, and the higher coverage level is going to cost you more. And again, if you can only purchase the highest level of coverage, 80 and 85%, if you can show that you are producing at least 3 commodities. So who is eligible for whole farm? In order to be eligible for whole farm, you need to be eligible to receive federal benefits and be a U.S. citizen or resident. You need to have your tax return documents, such as a Schedule F records going back 5 years. Beginning farmers actually only need records for 3 years. In some cases, you have to demonstrate that your operation has more than 2 commodities, which I mentioned earlier. And also, you must insure more than 1 commodity if revenue coverage is available for one of your commodities. So, for example, a corn producer cannot purchase only a whole farm policy if there's also a corn revenue protection policy available in their county. And there's also a quick note about potatoes. If you're raising potatoes and want to purchase whole farm to cover them, be sure to raise your hand or ask a question, because there's a special provision that says you need more than 2 commodities. You need to show you're covering more than 2 commodities to qualify for whole farm. So you've read about whole farm. You've decided that you want to purchase a whole farm policy for your operation. What's next? The one important step is to gather your Schedule F records for 5 years. Again, 3 for beginners. There are some exemptions for having those records for gathering all of those records for that whole period of time. If you are physically unable to farm for 1 to 5 required historic years, if you're a tax-exempt entity, such as a tribal entity, or if you have other acceptable records available. Those are some situations where you wouldn't need the whole 5 years. It's also, you also need to gather information about what will be produced on your farm during the insurance period. And other information is applicable: supporting records, organic certification, inventory, accounts receivable. So this is all with the goal of demonstrating to your agent what your expected revenue is, and how you come to your conclusion of what your expected revenue is for the next year based on reasonable estimates. So, but what if my operation is growing, and my records from previous years would only show that my expected revenue for this year would be a certain amount, but I know I'm going to be growing this year, so it's going to jump up. This is a wonderful problem to have, and Whole Farm also allows for it. So Whole Farm can account for projected growth of your operation, and you can still enroll. And there's something called a growth. I think it's the growth factor, and growth index. Sorry, growth index. And so you work that out with your agent, crop insurance agent. So a couple tips to enroll. The first is to find a crop insurance agent in your area. You can look them up on USDA's agent locator. And I had this so folks who were on our webinar on Tuesday will recognize this recommendation. I strongly recommend that that if you're interested in purchasing a Whole Farm policy this year, get started as soon as possible. I know that for folks in Iowa and Nebraska, the filing deadline for Whole Farm is in 2019 is March 15th, and which can seem like it's a long way away, but when you think about the work needed to contact an agent, set up a meeting, gather all your records, work with the agent, get that first quote, get all your ducks in a row, get it all worked out. It can take some time, so it's good to get the ball rolling soon. So that's why this is the slide with all caps words. So in this slide, I wanted to dig in a little bit into the question of how you show your expected revenue to your insurance agent, and what documentation and proof is useful to share with them to prove the revenue that you expect in the next year. So I pulled this directly from RMA resources. So prices and yields used to value commodities to be grown. They must meet the expected value and yield guidelines in the policy, which I believe you work out with your agent. So the values must be what you can reasonably expect to receive in your local area for the commodities. So this is at that point of, like if I'm living in Story County, Iowa, I shouldn't be using corn prices from somewhere very far away. For corn might cost something else. Marketing contracts it's important to base these to the extent possible on third-party sources. And also marketing contracts can be used at the time they become effective within the policy limitations. And then yields also must be what producers can reasonably expect to produce under normal growing conditions, based to the extent possible on your operations, production history, or other third-party sources. So that's why some of that documentation I mentioned earlier is necessary. So once you work with your agent, decide to purchase a policy, set up your policy, there are 3 reports required from you. So you'll work with your agent to write an intended farm operation report at the beginning of your policy, and then you'll have a chance to update it based on your year's activities in your revised farm operation report. And at the end of your coverage period, you'll file a final farm operation report. These are so your agent can, to make sure you're communicating with your agent about your production. And you work with your agent to find out the deadlines for those reports. I might have that detail later in the presentation also. Oh, sorry, no, I've got it here. Intended farm operation report is due on the sales closing date, which is should be March 15th. Revised farm operation report is probably due around July 15th. Your billing date is probably around August 15th, and the final farm operation report is the earlier of one of 2 things: the time when you determine a loss, or next policy year's sales closing date. So the whole farm, the work on the policy starts now and it extends for the year, which makes sense because it's you're ensuring a growing season. So I'm not sure whether anybody on the call is interested in ensuring organic production, but one of the great things about Whole Farm is that it is available to ensure organic crops and livestock where there isn't a specific policy available. If your farm is certified organic, or for farms with $5,000 or less in revenue, and you follow organic farm plan, then you can use what's called organic expected value. So this is how it allows you to insure organics. The prices used under whole farm insurance should always reflect the actual markets that you sell to. So when you go in to talk with your agent, you want to determine the right product for your operation. So you ask about, how big will the premium be and how much will you be responsible for, your payment deadlines, your reporting required, how to document and file a loss. I talked about some of this before, but on how to document and file a loss, this is also an important thing to make sure you've got you're paying attention to, because the time period for documentation can vary by plan. So just making sure you're talking through that. And then also one of the another piece of advice with Whole Farm is, because Whole Farm is so useful for diversified operations, sometimes agents will not be as familiar with your business model. So something to consider is to bring educational materials about your farm to your meetings with your agent, so that they, in addition to the other paperwork that you'll be providing about revenue and prices and markets, some of that just kind of like basic information about your operation is also helpful, so that they just educate them about your system and help build that relationship. I have a slide here about filing a claim. If you find that you need to file a claim within 72 hours of discovering that your revenue may be dropping below your insured level, you need to submit a notice of loss to your insurance agent, and be sure to talk with your insurance agent about that. After you file your taxes for the year, then you file your claim. So this is a little bit different from other insurance plans, where you have to file the claim in around January if you're filing your taxes on the calendar year calendar, and then you need to then file your claim within 60 days of submitting your tax forms to the IRS. So I'm going to do I'm going to do a little quick example. Folks on the Tuesday webinar will remember that we use the RMA's cost estimator tool, which you can find online, and it has a function to look up an RMA, a whole farm policy. It's obviously just an estimate, and you'll need to talk with your agent to get a quote, but it's a really handy tool. So I wanted to do a quick estimate here. So here's a screenshot from the cost estimator. So I was estimating, if in 2018, if I wanted to buy a whole farm in Marshall County in Iowa, they asked me some additional information about my example operation. And it's a little hard to see, but I'll just highlight the important bits. So I said that I'm a calendar year filer, which I mentioned a minute ago. To try to keep things simple, I said that I'm not a beginning farmer, that conservation compliance does not apply, that I'm not interested in multi-peril crop insurance coverage, and I also assume that my operation will not be growing. For this mock example, I said allowable revenue would be $50,000 every year since 2013, and then that would break out as $20,000 from non-irrigated corn, $10,000 from oats, $10,000 from other small grains, and $10,000 from cow-calf. So, if you put in, I put in all of these parameters into the cost estimator tool, and it shared with me, several numbers which are really useful. So, first, it shared a liability amount, how much of that expected $50,000 in revenue for next year could I cover, and then how much would that total insurance premium be for me, and then how much of that premium would I be responsible for? So, I won't read every number to you. I know everyone was hoping that I would read off all of these numbers, but one of the basic takeaways from it was, so this is almost analogous to a back of the envelope calculation. So with an annual revenue of $50,000 with a cow-calf operation, raising corn, oats, and other small grains, if I chose a 70% coverage level, this estimate here shows that the liability that whole farm would cover would be $35,000 of my revenue, and the total premium for that insurance policy would be $1,000, $1,225, and then I would be responsible for $245 because the difference would be subsidized. So I hope that was a helpful example. And so going back to the goals, we covered what is whole farm, how does whole farm work, and would whole farm be right for my operation? I hope I shared with you some useful information to help you so that you know better the answers to these questions. I hope you feel more informed on these topics. I have a couple of quick housekeeping things, and then I will open it up broadly for a Q&A. So again, a reminder, get in touch with, if you're interested in purchasing whole farm this year, get in touch with your insurance agent ASAP. And then also I want to flag that I and my colleague Cora Fox, we are here to answer your questions about crop insurance. We have our crop insurance helpline number here, and you can reach us at those two extensions and also at our email addresses. So please, if you have other questions after the webinar, please feel free to reach out. And then one last thing is we want to continue providing helpful information. So we have an email survey that you'll get as a follow-up email from the webinar. That has I think it has 2 questions. If you could just take 30 seconds to answer that quickly, we really appreciate your feedback so that we can share with you helpful information. So I will open it up for questions, broad questions. So a reminder that you can, there should be a little button where you can unmute yourself so you can speak up. And I don't see it. Oh, I do see a hand raised. Okay. I see a hand raised from Bobby Wilson. Bobby, I'm gonna, there. Go for it.
Hi. Thank you for the webinar. I had a question about how the prices are determined. So you said earlier that the price should match the market that you're selling into, and that you have prices set for organic and conventional. How are those prices determined? Is it based at all on your historic revenue for that commodity, or is it more of just a survey of the price that the average price in your county, or how does that number get determined?
Yeah, great question. So my understanding is that there are a couple different ways that price can be determined for your policy. I spoke with one agent who said that he would look at the nearest elevator that was that you could sell a organic corn to and pull that price. But then if you have a contract also, that's a pretty that's a really clear, obvious place to get the price from. So I think you have to you work it out with your agent, and it's because whole farm is can be complicated and if you're growing several different things, there aren't kind of like really easy, hard, fast point to this one rule. Like it's always determined this way. There's rules and there's guidelines, but it's not a set in stone, one size fits all.
Okay, so is it smart for you to know what those reference prices are before you start your policy? Like for example, if you're growing high value heirloom tomatoes and you know that you can get $6 a pound for them, should you compare that with the price that would be used to determine how much you get back in your claim? Like, is it just kind of smart for you to know what that price is to see how well it matches up with your expected price before you start your policy?
Yeah, I think any documentation that you can have to demonstrate that these tomatoes actually do bring $6 a pound is helpful for your agent.
Thank you.
Yeah, thank you. And if you want to follow up and talk more later, just let me know. I'm here. I also see Sarah Sivitz has, I believe, entered a question, but maybe that is from earlier. Thank you, everybody, for your patience with my learning curve with GoToWebinar. Okay, well, Sarah, if you have another question, please don't hesitate to ask. Is anybody on the call thinking of purchasing whole farm this year? And want to just kind of share what you're thinking? Okay. Any other questions about kind of the sign-up process for whole farm or any of the other things we talked about today? I know that the webinar platform is always, can create some challenges. So I want to just make sure that we have enough time for everybody to figure out where all the buttons are. But if we don't have any other questions,